When you look at the COMEX numbers and you can see that these bullion banks, the cartel bullion banks, have been holding back the price of silver for a very long time. In fact, 4 or 5 commercial banks holding the largest concentrated short position in any commodity traded on COMEX. It's in silver. But as the price has been rising, the losses on these commercial banks' balance sheet has to be extraordinary and borderline unbearable at some point. And they're going to be forced to cover the paper shorts. And I think that, we've always just taken for granted. People will say, well, they can just keep doing this forever. You can in an environment where the demand for those commodities is non-existent, but you can only manipulate a market over an extended period of time by pushing it in the direction that it is truly going.
For years, there's been a concerted effort to artificially suppress gold prices through extensive short selling of gold futures contracts. However, recent events in the last week of April or first week of May have shed more light on this manipulation. It's become increasingly evident that Western central banks no longer hold the financial clout to keep gold and silver prices down. Instead, China has emerged as the dominant player in the precious metals market, wielding significant influence over price movements. The power shift in global markets has important implications. Western central banks are finding it increasingly difficult to control gold and silver prices, especially with China's active involvement. China, along with its financial allies like Russia, India, and other BRICS nations, now dictates trends in the gold market. Their ongoing purchases are driving gold prices higher, out of the reach of Western financial authorities. Andy Schectman states these unusual market movements depart from traditional trading patterns, particularly in silver. Despite ongoing efforts by commercial banks to suppress silver prices through concentrated short positions, silver has demonstrated remarkable resilience. However, as silver prices surge, these banks face unsustainable losses, potentially leading to a cascade of short-covering actions. This shift reflects a broader erosion of trust in the Western financial system. Of particular note, Andy highlights concerns about dwindling global silver inventories, intensified by depletions across major exchanges like COMEX and LBMA, and significant developments in Shanghai. The decline in registered silver inventory on COMEX, down nearly 70% in 18 months, and significant reductions in silver vault levels at the LBMA in London indicate a potential shortage if withdrawals persist. Contrasting regulations for gold and silver exports from China underscore the urgency surrounding silver. Silver faces no such restrictions, unlike gold, which requires a deposit before export. Andy suggests that this discrepancy may indicate a pressing need for banks to address their significant short positions in silver. We will present clips from Andy Schectman's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
And you can see that these bullion banks, the cartel bullion banks, have been holding back the price of silver for a very long time. In fact, 4 or 5 commercial banks holding the largest concentrated short position in any commodity traded on COMEX. It's in silver. But as the price has been rising, the losses on these commercial banks' balance sheet has to be extraordinary and borderline unbearable at some point. And they're going to be forced to cover the paper shorts. We've always just taken for granted. People will say, well, they can just keep doing this forever. You can in an environment where the demand for those commodities is non-existent, but you can only manipulate a market over an extended period of time by pushing it in the direction that it is truly going. And the trust in the United States and the Western system has been extraordinary for a very long time, but it's as if the glass has been broken, and putting back that glass is akin to putting back the trust that has been shattered, at least across the entire Southern Hemisphere, if not most of the globe. So lately, there's been a lot of talk about the global inventories disappearing in silver. I mean, you look at COMEX, you look at the LBMA, it's got the lowest level of inventory, second lowest level of inventory for sure in the 140-year history. And now we're beginning to see things on Shanghai disappear. We've seen, and we'll talk about that, we've seen the ETFs be bled dry. Everyone says, well, there's great availability in the retail market. Well, that'll change, and it'll change really fast if what I'm seeing is actually happening. The American public has been asleep at the switch. They have been infatuated with NVIDIA and Bitcoin. They've even been infatuated with the 5% return in treasuries with no risk. I understand all of this, but they're missing what could be a generational move in metals and in particular in silver. Now, there was a lot of talk, and Mr. Jensen talked about all of a sudden you have bullion bankers showing up at the Shanghai Metals Exchange. Now, remember, the numbers on the LBMA, we're told there's 800 million ounces of silver there, of which 500 million belong to the ETFs. And when you realize that leaves 300 million ounces, that's about what is left on COMEX in the entire ecosystem. In COMEX, about the same amount, but in COMEX, there's only about 40 million ounces backing the contracts. The rest of it is eligible and it's not for sale. So who knows what the real numbers are, but they are, 300 million-ish or less globally on the Western system, and probably a lot less backing everything. I'll keep that in mind. But I did some digging myself, and I went right on to the Shanghai Metals Exchange website. And you can see for 4 straight weeks, starting the second week in March, first we had Deutsche Bank, then we had HSBC Bank, then we had JP Morgan, and then Standard Chartered Bank show up one after another for 4 straight weeks. And Jamie Dimon evidently is there right now. And could there be a coincidence with these 4 bankers showing up? And since that first week in March, the Shanghai Metals Exchange have bled down in silver to a new low not seen since 2020. Who knows what deals were struck in the back room at the Shanghai Metal Exchange, but it becomes really interesting when you realize something that I didn't realize until watching Mr. Jensen's interview, and that is that gold cannot be exported out of China without first depositing a bar into the Shanghai Exchange. So then you can export it. So this is contrasting with silver, which can be exported. And it would seem to indicate to me that the banks are there not to talk about gold. It would make no sense. They would have to deposit their own gold first into the vaults in order to export it. It makes no sense. They're there to talk about silver. And it almost speaks to a desperation. Please help us. We're trapped. We have massive short positions that are naked, and I'm going to get into that, but we don't have the silver. Help us. We'll work out a deal. Maybe it's gold related. Who knows?
According to data from the Hong Kong Census and Statistics Department, China's net gold imports via Hong Kong slumped 38% in April compared to the previous month. The recent uptick in gold shipments to Hong Kong, followed by their transfer to Shanghai, reflects a significant trend in the precious metals market, the growing importance of over-the-counter, OTC, transactions. These transactions, involving large volumes of gold kilobars moving from COMEX, highlight the profound effect of these less transparent dealings on traditional exchanges. However, Andy observes that the opaque nature of OTC transactions makes it difficult to accurately gauge their full impact on market dynamics. Substantial evidence points to a significant west-to-east flow of precious metals, particularly to China and Russia. This trend appears underreported in official accounts. Exchanges like COMEX and LBMA, dominated by paper contracts rather than physical deliveries, exacerbate this issue. A 2011 survey suggested that reported trading volumes might be understated, raising doubts about actual supply-demand dynamics and exposing the market to potential manipulation. In contrast, Andy asserts that the Shanghai Metals Exchange, with its stringent requirements for physical deposits, ensures greater market integrity. The recent influx of bullion banks to this exchange, alongside a noticeable depletion of silver stocks, raises questions about their strategies in the evolving market landscape.
What you have is a system that is opaque, and we can't really tell how much gold and silver are being transacted through the OTC markets. We talked about that last week with the huge amount of gold deliveries that are being delivered to Hong Kong and then trucked over to Shanghai, like massive amounts of gold kilobars off of COMEX. They're bleeding dry our exchanges, and it's all being done on the OTC market with not great transparency, and it's becoming difficult to tell exactly how much, but we do see the flow. If you look, you don't have to look very hard, you can see the flow from west to east, okay? So even the Financial Times recently just pointed out that the global flows of metal the real level of buying from west to east is, especially China and Russia, has been way, way understated from what is reported. This was just in an article that came out in the Financial Times. You just had a guy, an analyst from Bank of Montreal, say that China is massively understating what they're accumulating. But this is a trend that's been going on for a while. Why tell your enemy what it is that you're accumulating? This is misdirection. They're not going to tell us. But the analysts, the Financial Times and Bank of Montreal have at least had the courage to say those numbers that we are seeing are not right. They're massively understated. Okay. So what the LBMA and the COMEX have in common is that they trade spot gold and silver contracts. Let's call them promissory notices. Let's call them promises to deliver. But the point is that when these exchanges were set up, no one really ever stood for delivery, right? And these countries that are doing so right now did not have the wherewithal or the sophistication to do so. On COMEX, it's typically 100-ounce gold bars. They do have the mini contract, the kilo bars, which we have seen been flowing to China. In London, it's the 400-ounce gold good delivery bar. They both trade the 1,000-ounce bars. There was an article by Forbes magazine recently that said there is now vastly more paper gold and silver, physical, or at least gold anyway. They called it between 200 and 300 trillion in paper gold compared to 11 trillion in physical. So when you talk about this rehypothecation, when you talk about the ability to control the paper price by issuing more and more and more contracts, this is how they've played the game forever. They have rehypothecated the heck out of the markets controlling the price, which is really the kryptonite to the Western system. This is how they have, in concert with the COMEX, held the price down. The West has ruled the metals market forever by using this rehypothecation, this leverage, by permitting more paper claims to be created on the same amount of gold and silver allows the management of the price. It's not going to rise if you can way overwhelm the supply and drive it down, because in concert, the Western central banks had all the money, right? So I want people to think about this for a moment. Why is it that the commercial banks are showing up at Shanghai, and at the same time they're showing up, the Shanghai silver stocks are bleeding down to their lowest level in 4 years? So I guess I would say in conclusion, you cannot export gold out of China without first depositing the bar in Shanghai. We talked about that. We understand that. But you can export silver. And all of a sudden, these big bullion banks are showing up naked short, mind you, massively naked short to the Shanghai exchange for 4 straight months or 4 straight weeks, begging them, it looks like, for help. Think of the arbitrage that's going on right now. Silver at 36.01 this morning in Shanghai. Silver goes way up over a holiday weekend when the public has no access to the market. It's knocked down into Western trading, shoots right back up here. They're trying to hit it again right now. It's like we are entering a period of time where maybe these commercial banks are beginning to eat one another, that it's every man and woman for themselves.
If China continues to assert its influence over the silver market, it may disrupt the traditional dominance of Western central banks. This could render their attempts to suppress silver prices less effective, potentially leading to significant changes in the dynamics of the precious metals market. Share your thoughts on Andy's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.